Good afternoon, everyone. It's Pablo.zuanic, equity analyst at Zuanic Associates. I have the pleasure of welcoming the CEO of NewLake Capital Partners, Anthony Coniglio. Anthony, welcome.
Thanks, Pablo. Great to be back with you. How are you doing today?
I'm doing good. I'm doing good. We have a lot to cover, right? But let's just, for those that are not so familiar with your company, maybe just a brief history of NLCP of NewLake from
Sure.
the IPO time. How has the book grown? And then also, how have market conditions changed since the IPO and/or versus your expectations back then? Thanks.
Sure. Happy to do it. Once again, thanks for having me. Great to talk to you again, as usual. NewLake Capital Partners, we're a real estate investment trust or a REIT that was founded in 2019 and went public in 2021 under the ticker symbol NLCP. We're currently, by our estimates, we're the second largest owner of cannabis real estate in the country. We own 33 properties across 12 states with 13 tenants, and our top three tenants are some of the leading companies in the industry, names like Curaleaf, Cresco, and TruLeaf. In terms of how have we evolved over time, yes, in the beginning, from 2019 through 2022, was really a torrid pace, quite frankly, as we all know, of capital raising across the industry, expansion, and a real CapEx cycle. And that's where a large number of our acquisitions happened. And then into 23 and 24, that pace slowed down. And this ties into what's changed, your last question around what's changed for us versus our expectations. I would say that there's some things that are as expected and some things that aren't. I would say that we always expected that there was going to be price decreases as this industry commoditized, but we didn't expect that it would happen so quick. We always expected that the state turn-ons, as we would call it, that would be states adopting a medical program or states converting from medical to adult use. We always did expect that to move to the red states, states like Missouri and most recently Kentucky. But what we didn't expect is that we'd still be sitting here with a lack of federal reform. We would have thought that we would have been farther down the path from a federal reform perspective. But we are where we are today. As I said, 33 properties across 12 states, and we've got available capital to put to work. But excited to get into this conversation with you today because there's so much going on in the broader industry and obviously what happens in our corner of the world.
All right, that's good. Thank you for that. So just a brief recap of the fourth quarter results, and overall, how would you describe your performance in the last 12 months? I mean, from my perspective, maybe there hasn't been a lot of growth, but maybe that's a good thing. You're being conservative. Just some context there.
Yes. So briefly, for the fourth quarter, we generated over $12 million and approximately $11 million of free cash flow. And as a real estate investment trust that pays a quarterly dividend, our key metric is available funds from operations, or AFFO. And when you look at that AFFO payout ratio, you'll hear me talk a lot about that, as you know, Pablo. But for those that aren't as familiar, that's the measure of what percent of our free cash flow do we pay out in a dividend. And we paid out 83%, which means we have 17% of free cash flow sitting on the balance sheet or being retained by the company. And so solid performance in the fourth quarter. For full year 2024, our payout ratio was 83%. We actually grew AFFO per share by over 8% during the course of the year. And so I guess that's a good transition into how do I feel 2024 did. I guess one word would be steady. I think that in the face of that continued very difficult operating environment for the tenant base, for the cannabis industry, being able to grow AFFO by over 8% is an achievement that we're really proud of. We're not perfect, and those that follow NewLake will know we're not afraid to say when we have issues in the portfolio, and we do have one currently. I'm sure you'll get into that in your Q&A here. But being able to deliver that type of per share growth on an AFFO basis and grow our dividend is pretty important, I think. And on the dividend, we grew our dividend 10% over the course of 2024 from, gosh, we were at 39 cents a share and we ended up 2024 paying out 43 cents a share. That is per quarter. And so the ability to grow the dividend in the face of a difficult environment, grow AFFO per share, I think really reinforces my view that we performed in a steady fashion for our shareholders and positioned for 2025.
And on the same topic, even looking outside cannabis, when you look at other sale-leaseback operators in non-cannabis industries, what metrics would you look at in comparing NewLake with them that would say we are performing better than them or we're more attractive than them, even maybe thinking valuation?
Yes. So I would focus on equity REITs. And for those that aren't very familiar with the REIT industry, let me just say there's different types of REITs. There are mortgage REITs, there are equity REITs. As a triple net lease REIT, which is what we at NewLake are, it means we own the property. And so let me just briefly explain. What we do is we acquire properties from and for cannabis operators, and we lease them back on a long-term basis. The yield on our portfolio today, that effective cap rate, is around 12%. It's a little bit over 12%. And the remaining weighted average lease term on our portfolio is over 13 years. So that's a higher yielding real estate portfolio with a long duration. And we own the property, and the expenses of the property are borne under that triple net construct are borne by the tenant. So that gives you a sense for it. So when you look at equity REITs, and you look at their valuations, you'll find that equity REITs are trading in the, call it low to mid double digits, anywhere from 12 to 15 times AFFO. That's that multiple I was talking about. They also have payout ratios that will range anywhere from 70 to 90%. And our stated range of that payout ratio, Pablo, as you well know, is between 80 and 90%. And during 2023, we were around 83%. During 24, we were around 83% as well. And so when we look at those key metrics relative to the non-cannabis REITs, I'm sure we'll get into this later, but we're way undervalued relative to those metrics on an AFFO multiple or even an NAV multiple. When somebody looks at our net asset value and where we trade relative to that NAV, it's a significant discount. I hope we get an opportunity to talk about that.
Just on that point, I mean, do you think it's a discount because of cannabis, or is it a discount because you're not NYSE listed? I mean, there could be many reasons, right? But how you think of it?
Yeah. Yeah, I'd say there's three primary reasons, and I think you touched on two of them. First, REITs generally move in a correlated fashion, negatively correlated with rates. And that's because REITs typically utilize significant debt in order to get the targeted return to their investors. I should note, we're probably one of the least levered REITs that exist. We barely have any debt. We have $7 million of debt on 440 million, 445 million of assets. So that's almost unlevered, which is typically unheard of. Usually REITs are running with much, much more leverage. And so therefore, when rates go up, the NPV of future cash flows is viewed to decrease. For us, it's less of an issue. But because we're a REIT, we get lumped in with that general population or that general perspective. So that's reason number one. Reason number two, as you pointed out, is the industry we focus on, cannabis. As we all know, there's been significant headwinds to the industry over the last couple of years. We could see it in the equity prices for both equity prices as well as bond prices for the industry. And so people look at us and they say, wow, you've had a great run in terms of portfolio performance, but there needs to be more beneath the surface. There must be more defaults that are just around the corner. And there have been some, well-publicized defaults in the sector that I think people are looking at us saying, boy, you must have some of the same. And so we get caught up in some of that. Some of our competitors get a cold and we get the proverbial flu. So that's reason number two. And then reason number three is, when people are looking at us trading on the OTC, even though we comply in all respects to be on New York and NASDAQ, it has a chilling effect on, actually, not just a chilling effect, but it has an actual effect on custody. Institutions are limited in their ability to custody our stock because we're not traded on New York or NASDAQ as a marijuana-related business, much the same way you see that happening for the MSOs in the sector. And so when I talk to institutional investors and they see some of these valuation metrics, and I've been talking about this at investor conferences over the last couple of weeks, when those institutions see those metrics, they say, my gosh, what a great opportunity. I get it and I love it, but I can't act on it because I can't have my prime broker custody your stock because you're not on New York and NASDAQ. And so our story seems to be resonating with more of the high net worth individuals, retail investors, and small institutions that can custody our stock at brokerages like E-Trade or Fidelity or Interactive Brokers, to name a few. And we even have a drop down on our website that lists the brokers we are aware of that will custody our stock. And so it's those three reasons that I think are really holding down that valuation metric for us.
Right. And on that specific point, I mean, can we expect any changes for the better in the next 6 months or 1 year, whether it's a NASDAQ listing or whether, other brokers provide custody for institutional investors, or it's unreasonable to expect that in the short term?
Yeah, this is probably one of the more important issues for our investors. It's something we talk about almost every quarter. We're acutely focused on finding our way to a better liquidity profile, to a more liquid market that can unlock some of that value. I can't predict what will happen over the next 6 months. What we did say on our most recent earnings call is that we had been evaluating a TSX listing, but we have put that off to the side for now because we don't think there's the benefit to doing what we need to do and the costs associated with the structuring modifications that would be necessary to accomplish that listing. But it is something we could always look at in the future when the dynamics have a better cost benefit return for our shareholders. So no, I don't think anybody, and I would never want anybody to enter into NewLake thinking that there was a potential uplisting on the horizon. I want people to invest in our company for the fundamentals of our business, but understand that we're acutely focused on it. And over time, we're going to figure out a way to get ourselves to an exchange that could really unlock that appreciation for the portfolio we've created, for the underwriting approach that we've developed, and for the value I think we've created for our shareholders in growing our dividend over 80% since our IPO, or approximately 80% since our IPO.
That's great. We'll come back to questions on valuations and maybe the direct comp in the sector at IPR. But let's just move on here first to your read about the state of the cannabis industry at present, right? How have things changed for better or worse? Operator economics, debt leverage, outlook of your potential tenants. If you can just speak in general about that.
Sure, sure. From our seat, we talk to a lot of operators, both in the portfolio and out of the portfolio. And listen, it's our job to be monitoring this sector, so we try to understand as much as we can about it. From my read, I think what we're going to see here for 2024, excuse me, 2025, is more of a range-bound performance from the operators. I think there was a lot of the low-hanging fruit and the big boulders, so to speak, that operators could move to really move the needle on their operating performance. I think those were largely accomplished in 2024. And so for 2025, while operators are continuing to optimize their performance, optimize margins, optimize operating performance, minimize expenses, the opportunity to do that at a greater scale, that diminishes since they've taken a lot of the big benefits already. They'll continue to do that work, but I do think we're going to find ourselves somewhat range bound, whether it be from a revenue perspective or from a margin perspective, because let's face it, the growth opportunities from state activations just aren't there for calendar year 2024. We're going to get some growth out of some markets, yes, and I think some of the other markets that either converted to adult use in years past or we're waiting to get to adult use, we're going to see those deliver some stable numbers. So not a lot of movement on the revenue side, not a lot of movement on the margin side. I think we're going to be range bound for this year from an operator performance perspective.
Right. And on the same topic, I mean, again, I know it's hard to generalize, but when you compare private operators with the public companies, is it fair to say that private operators may be in better shape because they couldn't overexpand? They didn't have as much access to capital 3, 4 years ago as the PubCos did. So maybe as a result, right now, they are in better shape. Or is that just wishful thinking?
I, I wouldn't generalize. We have some private companies in our portfolio that perform really well, better than some of the public companies. Yeah, I think it really depends. I could think of numerous public companies that are in difficulty. Some are doing well. I could do the same thing on the private side. I think what it comes down to is that management teams focus on balance sheet and cost control and operating cash flow. And whether they're in the public sphere or the private sphere, those focuses, those acute focuses deliver results.
Right. Look, we want to be focused here on fundamentals, right? Especially from a sell-leaseback perspective. But your latest thoughts in terms of what may happen on the federal level in terms of regulatory reform this year. Just brief answer. I know we've
Yeah.
many times, right?
Listen, you've heard me say it before. I take the over on anything government-wise. So I don't expect any action soon. We're certainly not expecting, in the way we underwrite transactions, any federal reform. If it happens, that would be great. We'd love for it to happen. We advocate for it to happen. I was down in DC last month, spending some time down there with others in the industry, trying to advocate for some reform. We'll continue to do that. But at the end of the day, nobody knows. It would be a pure guess to put something out there. So we're going to prepare for no reform, but we're going to keep advocating to get some soon.
Right. And again, I know it's opinions will vary on this. I mean, all this recent volatility we're seeing, tariffs, trade wars, potentially ZISO in the bond market, in the stock market. Does that translate into fundamentals for the cannabis industry, whether to the operators or the consumer, or not necessarily, in your opinion?
Let's peel that apart into two pieces. Let's talk tariffs and then we can talk rates. The work that we've done from a tariff perspective is that it's going to have limited impact on the industry. And it'll obviously, like many things, depend on who the operator is and most importantly, what form factors and what products they're manufacturing. Let me peel that apart a bit. So what we've identified as probably the most sensitive to tariffs would be vape carts. And we all know that this is significant supply chain coming out of China for vape carts. But when you look at vape carts and packaging is another component, when you look at those as a percentage of the overall expenses in a cultivator and operator, you'll find that they're anywhere between 5 and 9% of total costs. I think some of that cost increase can be passed on to the consumer. I worry that not all of it can, otherwise we start pushing consumers back to the illicit market. So I think some of that's going to be passed on. And so when I think about the impact on margins, it really shouldn't be, it should be very manageable. Let me say it that way. I think it should be very manageable for those that are into the wholesale side of the business. And for those that are more retail oriented, it should be less of an issue. Now, we also benefit as an industry that we're not in a large CapEx cycle. If we were in a period where we were trying to build out many, many markets, now Kentucky is the exception this year as it tries to build out its own market. That's where you're going to see, I think, the bigger impact from tariffs with construction costs and material costs and equipment costs will be impacted by tariffs. So to summarize that, I really don't think tariffs will become a big issue for the industry. I think the industry is resilient. It showed that during COVID, it can adapt to any supply chain disruptions. And I think the smart operators have been planning ahead for this, either stockpiling products that might be subject to tariffs or looking for alternatives. So in summary, tariffs, I think, are manageable for the industry. Rates. Well, now that's a much more complicated issue, and I've been tweeting out a little bit about this. There's so many cross currents when it comes to information on rates. Let's just touch on a few of them. We had the jobs report a few weeks ago, which suggested there is no problem in this economy and that jobs are plentiful. And so there's no reason for the Fed to act to try to stimulate growth, to stimulate jobs, which is one part of its mandate. So the jobs report would suggest Fed needs to do nothing and should stand pat. We have a healthy economy. On the other side, we're starting to see some inflation abating. You look at the most recent CPI and PPI report, and you say, okay, well, that looks pretty good. Maybe we're really getting on a glide path here around inflation. But then again, you have tariffs. Well, we know tariffs are inflationary. So wait a minute, we're going to go the other way, and now we're going to put inflation onto this economy. But wait a minute, oil has sold off, and oil was trading down in the low 50s and now up around 60. Well, guess what? That's disinflationary. So you have a lot of these cross currents. It's really hard to know where inflation is going to settle out, where the economy is going to settle out, especially in a world where recently we're looking at confidence indices, which are dropping through the floor. So it's a really uncertain time. Where do I think this all ends up? I think by the end of the year, we do have a softening economy. I think it'll set the stage. I think the jobs number plus inflation, I think will set the stage to allow the Fed to ease one or two times before the end of the year, bringing down the shorter end of the curve. But on the longer end of the curve, call it the 10-year and beyond, I think rates will stay elevated because I doubt, I'm optimistic as a person, but I'm pessimistic that our government in DC is really going to get these deficits under control. And so therefore, I think we're going to have higher for longer on the long end, potential for a short end of the yield curve, which means a steepening. Let me try to summarize that. What does it mean for this industry? I just think it means higher for longer. I think cost of capital will remain higher for this industry for a prolonged period of time.
That's great. Thank you for that, Anthony. That's very clear. Just shifting gears a little bit for those that are not so familiar how sale-leaseback works, maybe just explain how it works and then what advantages does it offer versus other financing options for operators. And as you discuss that, are MSOs moving away from sale-leaseback and using other options to fund growth? Just the current landscape in that sense. Thanks.
Sure. So sell leaseback is not a strategy that's only for the cannabis industry. In fact, if you were to look at, say, Walgreens or Starbucks or FedEx or Home Depot, those are all companies that have large real estate footprints and utilize sale leaseback in their arsenal to fund their real estate needs. So what do? We acquire properties from and for cannabis operators, allowing them to take their precious capital and focus on their operating needs, improving EBITDA and cash flow for investors, rather than having that capital tied up in a hard asset like real estate. And again, that's what the Starbucks and the Home Depots and FedExes of the world have realized. So this is a regular way tool for real estate capital for all industries. So let me go a little deeper. So when we say we acquire from and for, this really think of it as three categories. Category one is where an operator has used that precious capital to acquire a property, and they're operational at that property, but they may have one, five, 10, $30 million tied up in that property. It's an opportunity for them to raise non-dilutive capital by selling that property to us and then renting it back from us on a long-term basis, 15 years, 17 years, 20 years. And so there's no operational disruption. They're able to obtain cash for the property that they have into the property. That's number one. Number two is we will acquire on behalf of a tenant, will acquire a property that needs refurbishing, and then we'll provide tenant improvement dollars for them to refurbish that property to either be a cultivation facility or a dispensary. And within our portfolio, I should say we have 15 cultivation facilities and 18 dispensaries. So that's number two. Number three is we'll acquire a piece of land on behalf of a tenant and provide them the capital to build a brand new building. And in fact, that's what we did in Phoenix, a project we completed in the fourth quarter of last year, 100,000 square foot industrial building for a cultivation facility for mint cannabis. So that's how our business works. And then we collect rent on a monthly basis and pay out a quarterly dividend to our investors. Your question about our MSOs moving away
Yeah,
from sale leaseback.
let me just interrupt you there for, I'm sorry.
Yeah.
Before we move on to the MSO question, what about, your cap rates or the cost for an MSO, right? Compared to a mortgage REIT, or I know they are shorter duration, but is there a cost element? Is there an advantage or disadvantage? Or that's not the right way to think about it here, given the other dynamics?
Yeah, I don't think about it that way. I think mortgage REITs, equity REITs like ourselves, senior secured lenders, I think there's a place for all of those in the cap structure of a company, depending on where the company is in its life cycle. And we coexist with all of those today with many of our tenants, as well as, again, outside of the cannabis industry. So I don't view it as better or worse. I view it as a different approach, and they all have their pros and their cons. In terms of cap rates today, cap rates for this industry are going anywhere from 11.5 to a 14%, depending on the type of property, the location of the property, the operator, and the cash flow profile of that property. There's many, many components that go into underwriting and pricing the risk. But that gives you a general sense for where that could be. And duration, again, is, call it 15 years on a lease term, with our portfolio weighted average remaining lease term a little over 13 years today.
Right. Yeah. And then thank you. And then moving back to that question about our MSOs moving away from sale leaseback and using other funding options.
Yes. And so here's where I get to the where we are in the cycle for the cannabis industry. We're not in a CapEx cycle. So we're not seeing large expansions in existing states, because in few states are we seeing this activation from medical use to adult use. Now, we did see some of that in Ohio, but the Ohio licensing and the size of the market and the slower rollout has negated much of the CapEx need to expand that market. There was already, I don't want to say significant, but there was already available capacity there to scale up with the industry as it's converted from adult use slowly from medical use to adult use. Kentucky's a different story. Kentucky has to build an entire new infrastructure in order to get their medical program off the ground. But that's really by and large it at this time. Whereas if you went back a few years, you had many more states activating a new medical program or a new adult use program. And so we're just at a different point in the cycle, number one. Number two, we estimate that there's over $2 billion of real estate sitting on balance sheets across the publicly traded companies and a lot more in the private sector. But over the last couple of years, as refinancings of senior debt has occurred, what they've had to do is take any available assets, for many of them, any available assets, and pledge those as additional collateral to secure those extensions. So a lot of that available real estate is being utilized as collateral for those senior secured positions. And so what I do think will happen over time is not only will we get back to a CapEx cycle where we're seeing more state activations for both medical and adult use, but we'll also start to see a recalibration of these balance sheets over time where operators and lenders alike will recognize that perhaps it's a better use of capital to monetize the real estate that they own and deploy that cash to either repaying down debt or investing in the business or a combination of both. But I think it's going to take this industry a little bit more time to stabilize its free cash flow profile and have a little bit more certainty around the regulatory outlook before those senior lenders will allow that quality collateral to be released.
Got it. I definitely want to go there deeper on some points there and also talk about the competitive landscape in the US. But just outside the US, are there opportunities for you, say, in the Canadian market or in Europe, right? I mean, I suppose the Canadian LPs have more access to capital right now, but how do you think about that?
We do think about it, and we've been spending a little bit of time learning about the European markets than the Canadian markets. We've had conversations over the years with Canadian operators. The banks in Canada will sometimes service those operators, and so from a cost to capital perspective, some of that capacity is more cost effective for operators than looking at sale leaseback facility. But we're really eyeing the European market to try to learn more about it and identify opportunities. And I spent some time there last year, and I plan to spend more this year. And what I've learned is that that market is probably anywhere from 6 to 8 years behind the US market in terms of its development, its maturity. In some cases, it's a slightly easier market to provide capital to because that market has grown up really as an outgrowth of pharmaceuticals. And so they look and feel to institutional investors as a more investable pharmaceutical-oriented company than, say, some of the legacy businesses here in the US. But listen, it's a small market. It's still an evolving market, but it's one we're paying attention to see if there's opportunities for NewLake and our shareholders.
Yeah, no, of course. All right, so then just moving back to the US, let's talk about the competitive landscape. Is it mostly you and IIPR, or are there also other private sale leaseback operators in the space?
I've not come across any new entrants to the space, and we probably have not probably, we have fewer competitors today than when we started the business in 19. I think on a local basis, there's always somebody on a local basis that's looking to do a 1031 exchange. But once you get above $3 or $4 million, those quickly fall off. And then it really is people that focus on the sector like ourselves. And I'm really not aware of anybody else out there that has the capital capacity to be able to execute new transactions. And in some of the deals that we're working through in our pipeline, I haven't heard from folks in the marketplace that we're competing against some new operator that started, some new fund that started a sale leaseback strategy. I'd say by and large, it's the typical groups that we've been bumping up against for the last couple of years.
Right. Because back, I mean, about 4 or 5 years ago, people used to go out, very decent, Treehouse, but they're not as active anymore, right? From what I understand.
Correct. I think given the difficulties in the sector, it's exceedingly more difficult to raise capital around any strategy in cannabis, let alone a sale leaseback strategy today. I think the capital that would want to find its way into a sale leaseback strategy, I think will be looking for a track record through this difficult period of an underwriting process that's held up to scrutiny and difficulty.
Right. So look, we want to talk now about IPR. I mean, it's the most direct comp, I mean, the only comp, right, in the space. Let's talk about it in 2 ways. One, go back to the valuation discussion, right? What metrics are you looking at to compare your valuation with that of IPR? Let's start with that. And then we'll touch some of the tenant issues they've had and the read for you.
Sure. I'll start this by saying I very much respect my colleagues at IIPR. I think they've done a great job in starting. They were the first to be done, grew their business, and really have a lot of respect for them. In terms of the multiples, the key multiples for us, the key metrics that we look at when talking with investors, and number one, the AFFO payout ratio. AFFO for a REIT, available funds from operations, is our key metric. That's our measure of free cash flow. And last year, as I said earlier, we paid out 83% of our AFFO in dividends. That means that 17% of our free cash flow resides on our balance sheet. Uh, and so that why that's a key metric. And by the way, we target between an 80 and a 90% payout ratio. It's a key metric because it tells investors the cushion to the dividend. Because as a REIT, when somebody's investing in us, they want to make sure that our dividend is durable and we're going to continue to pay our dividend. And so we have 17% cushion in our free cash flow before we grow AFFO from either our in-place escalations or putting out the capital that we've committed or securing new transactions. Before we even get there, we have 17% cushion. So that's a key metric that we look at. From a valuation perspective, comparable across companies, REIT investors look at an AFFO multiple. And so when you look at where we're trading at below 7 times AFFO multiple, that's probably half of what the general equity REITs are trading at, kind of mid-teens, low to mid-teens AFFO multiples. So we're trading at a significant discount to non-cannabis equity REITs. And also on an NAV basis, you look at where we're trading on an NAV with NAV of approximately $19.30. And I haven't seen where we are today, but it's been a significant discount to that. And so those are the two key metrics that I'd love to see investors really appreciate the quality of the portfolio and the durability of the cash flows that we've assembled.
Right. And then we want to jump into your book, but first, again on IPR, and of course, we're going to be mindful what we say here, but they have had some tenant issues recently. That there was an issue with PharmaCann that was announced in December. Then they had some other ones announced recently, and they had others in the past, but it seems that trends have been worsening, right? How much read is there for NewLake from that, or is it more of an isolated matter?
Yeah, so there's only one name that overlaps between those names that you were just mentioning in our portfolio, and it's PharmaCann. It's a very small portion of our portfolio, and what we've disclosed is that they've not defaulted on rent, so not a read through there. In terms of our portfolio, what I would point to that we disclose is our EBITDA coverage. Just talk for a moment about the way we approach our underwriting. What we like to focus on is limited license jurisdictions like a Pennsylvania or an Illinois or an Ohio, where there are limited licenses. And what do you get with a limited license jurisdiction? You get two things. You get a better operating environment with less competition, which means potentially better margins, potentially better cash flow, which means better credit quality and more likely that they'll be able to pay rent. The other thing you get is because they're limited in nature, there's demand typically for those licenses. So if there's financial difficulty, it's easier to find a replacement tenant in a limited license jurisdiction than an unlimited license jurisdiction, say as Colorado or Oregon or California. And so I think that focus for us on limited license jurisdictions has served us well. The other focus in our underwriting is on property level cash flow. We look at the EBITDA coverage. That's EBITDA plus rent. We disclose this in our in our investor presentation on a quarterly basis. By underwriting transactions where we feel comfortable in a world where there's price compression and margin compression, that the tenant can still generate cash flow sufficient to cover rent and provide them with the returns they're looking for, we can be confident or have an increased level of confidence that that property will be able to continue paying rent. And so I think that's another key element to what's helped our portfolio perform. And so we look at those EBITDA coverages on a regular basis. We're talking to tenants all the time. We're understanding the markets we're in. We're trying to be proactive to understand if there's issues, if they do arise. Not perfect. I'm sure you'll get to this. We have a tenant in our portfolio that's in receivership, so I'm certainly not trying to communicate that we're perfect here. But it's a name we've been talking about for quite some time, and it's not going to have a significant impact on our AFFO, just a few percentage points if we do get that property back. And again, with that 17% cushion, we'll still have very ample cushion to continue paying that dividend.
Right. And before we touch on those, so in terms of EBITDA coverage, not every company discloses that, to my knowledge, on the sale-leaseback space, but do you have a sense of how does your average EBITDA coverage compare with other sale-leaseback operators out there?
Yeah, we actually have a chart on our in our deck, maybe page 12, I forget exactly. But in that bar chart, we do show that we're just over 4 times EBITDA coverage. And look at other net lease REITs in the non-cannabis sector, and they're anywhere from high twos to mid threes. So, we're meaningfully above that across the portfolio.
All right. Oh, that's great. Now let's talk about, the book size right now. You talked about the number of properties you have, and then, any problem issues there. I think Calypso and Revolutionary Clinics are issues, but let's start with the book size, number of properties again.
Yes, so we've invested about $445 million across 33 properties, 12 states, 13 tenants. The one tenant in Massachusetts that's in receivership is Revolutionary Clinics. Receiver took over in mid-December, and we announced on our fourth quarter earnings call back in March that we have an agreement with the receiver for them to stay in place and continue paying us a portion of rent consistent with what was paid pre-receivership. That was 50% rent. And so we expect to continue to receive that according to that agreement during the receiver process, which should go through the middle, if not the end of the second quarter. Hard to know exactly when the receiver will wind up his efforts there. And we'll see if the receiver is able to find a buyer for the business or if we're able to backfill the property. That would be terrific. If we have to take the property back, we're going to continue to market it for tenancy. So if anybody out there is looking for space in Massachusetts, feel free to reach out to us, info@newlake.com. But again, the impact on our AFFO payout ratio is only a few percentage points, as we've disclosed. So not a meaningful issue for NewLake in terms of being able to meet its dividend. Let's talk about the other one, Calypso, which is in Pennsylvania. Go ahead.
I'm sorry, before we move on to
Yeah.
Calypso, as we saw in the case of IIPR, they let a couple of their tenants walk away from leases in Massachusetts, right? I believe one of them. There seems to be less demand for property in Massachusetts for cannabis, right? So I know you cannot guide too much here, but the idea that you'll be able to find someone interested in that property, is there something very unique about this property that you think there could be demand for it, or you may just have to take it back and make it available for other uses, non-cannabis? And again, I know you can't guide too much here. Yeah.
Y- these situations are, let's just say, fluid and different. We've had a couple of people come through the property already to take a look at it if the receiver isn't able to sell the business. No way to know where that goes. What's interesting about Massachusetts is I hear stories of organizations that are making meaningful profits operating in the state. And as we know on the other end, there are organizations that are suffering and shutting down as our tenant is there. And so for those that might be interested in expanding their capacity, and our building happens to be 4 floors that can be subdivided, there could be an opportunity for us to get some cannabis tenants into the building, but it's going to be difficult. You're absolutely right. It's a very difficult market to operate in, and I'm not here saying that it's going to be easy for us to re-tenant this in 3 weeks. Certainly not the case, but we're going to work at it, and we're also going to look for alternative uses, whatever it takes to maximize that return for our shareholders.
Right. And regarding Calypso, I mean, obviously expand on Calypso, but also remind us, is it just a couple of percentage points or is it more exposure to your AFFO?
Yeah, it's about 5% of our annual base rent, a little bit more than that. But what's different about Calypso is it's in this limited license state of Pennsylvania. And with Pennsylvania discussing adult use on the horizon, we've had significant inquiry about the property. And what I've said on our call is that if there's an interruption to rent, we think it'll be short-lived because of the significant interest in cannabis operators in the state of Pennsylvania. And so that's an evolving situation. I'd note that we were using security deposit, but through the end of the fourth quarter, including 3 months of using security deposit, they had never missed a payment since the inception of that deal some 2 or 3 years earlier. And I think part of that is because it's focused in this limited license state. It's a super high quality facility. We've heard that from many people that have come through. And so contrary to Massachusetts, where a bit more hesitant. Here, what you're hearing from me in Pennsylvania is there's been much more interest. And again, as I said, if there is interruption to rent, we think it's short-lived because of the state, the quality of the property, and the opportunity for adult use.
Yeah. And did you guide for the rental from Calypso for the first quarter, or should we
We did
assume?
not guide. No, we don't provide forward guidance.
Right. Okay. And again, in terms of what you can share, what other parts of the book could be at risk? I mean, we've seen these surprises at IIPR. I'm not want to mention any names here, but you're pretty comfortable. The rest of the portfolio is current, right? Tenants are paying the rental. Anything you want to highlight on the rest of the portfolio?
Yeah, I mean, listen, we focus on the cannabis industry. There's a reason the yields are higher because the risk profile is higher. And so, yes, we have some super high quality tenants in the portfolio. Again, our top three are Cresco, Curaleaf, Cresco, and Trulieve. But every month in this industry is difficulty. And so, we stay vigilant. We talk to our tenants all the time. And so just because we've been fine through a certain period of time doesn't mean we relax and we're not focusing on the portfolio. But we also have this EBITDA coverage that we've been tracking on a quarterly basis with our tenants because of that property level reporting that allows us to have insight on the trajectory of these properties and are they providing cash flow for the tenant or not. And so I'm never going to sit here and tell you that we'll never have another problem in our portfolio. How can that even be possible? Even away from cannabis, you see 98, 97, 95% lease rates across regular way real estate, especially when you have long duration portfolios like ours. And so it's not about that. It's really about judging us on how we work through the difficulties that come in and how we're able to manage our AFFO payout ratio and continue to provide cushion to our investors for the dividend that they come to expect on a quarterly basis.
Right. And obviously, I understand the logic of, I mean, the use and what the EBITDA coverage metric tells us, but not to push back on it. Some of that EBITDA could be being used to pay down debt or to pay down other issues, right? So the fact that you have a higher EBITDA coverage is not necessarily, it's a good sign, but the company would be using that EBITDA for other things, right? And that
So
ability
yeah,
to be compromised. How do you
here's
think?
the way I think. I'll tell you the way I think about it. Uh, so I was a banker at JP Morgan. I was a banker at JP Morgan during the great financial crisis, and my group had significant credit capacity, credit lines open at the time we went into the GFC. I spent 2 years with the workout people. We didn't lose any money on our lines. What I learned coming out of that is when a company is in distress, what they will do is they will cut off paying those assets that don't generate them free cash flow. So when I look at our properties, and if we have a property that's generating cash flow for an operator, why would they jeopardize default and eviction and cut off the cash flow that's so vital to the operations of that business? And so if we were to look at some of the problems in the industry, I would bet when you pulled apart that onion, you'd find that it was really an issue about cash flow at that property level that made that tenant say, I'm no longer going to fulfill my obligation. What we also have in our transactions is parent guarantees. So the ability to go after the parent for the default of the tenant, the property level tenant, which is usually the local licensed or organization, to the extent that we have a good tenant on the other side or a good guarantor, that's another important tool that we can press on. So we'll very much enforce our rights vigorously for those that selectively default. But when I look at that EBITDA coverage, that's why I draw some comfort, because if it's generating free cash flow for the tenant, they'd be wise to continue paying rent to keep that spigot open.
Sure, that's great color there. Look, I mean, sorry to go back to the IPR comparison, but uh, what other metrics can investors look at analyzing your book versus theirs, right? Like rental rates per square foot. I think we touched on EBITDA coverage. Apparently, you have more exposure to you have less exposure to you have greater exposure to license restrictive states. So you screen well in most of those metrics, right? But especially based on the math we've done, the rental rates seem to be higher than yours on average. I don't know if that's correct. But just again, some expand a little bit in terms of how people should look at your book versus theirs.
Yeah,
And
listen, actually, I think I'd point people to your piece, Pablo. I thought you did a nice job in December of putting out a piece trying to explain to investors that price per square foot. And so I think that's part of it. I do. I think that that is part of it. I think also this focus on EBITDA coverage is an important component as well. Um, I think I want to leave it there.
Okay. No, that's good.
I think investors can look at your piece.
Yeah,
I think they can look at our EBITDA coverage,
right. The
and look
only
at the
question I
limited
would ask,
license.
yeah, the only question I would ask on the rental rate is that if some of the rates are very, more than 10 years and you have these escalating clauses, right? That may explain the higher rental rates, or there could be many other things. It's not just about that.
Yeah, well, listen, some of it is math. If you start at a higher rate and you escalate, you're going to get to a higher level.
And
But
yeah,
again, I go back to EBITDA coverage. When we're looking at transactions and we're modeling out what an operator can do at a location, we're modeling that out over the longer term with the expectation that there'll be price compression and margin compression over time because this industry is just what happens. And so we're looking at that and we're looking at what is that effective rental amount relative to the rent, excuse me, relative to the revenue and the expected EBITDA that that property will generate, making sure that there's comfortable cushion for the operator to continue to generate return for its shareholders.
right.
And so what we try to avoid when we underwrite is we try to avoid scenarios where you'll find at some point during the lease term where the economics for the operator aren't sufficient to justify paying rent to us. And so that's part of that underwriting process that we focus on. And then some of it is just math. If you enter in at a higher rate and you have a higher escalator, you're gonna keep growing that number, and your model would show that at some point
Right.
it significantly eats into the return availability to the operator. And so that's when we underwrite, we try to avoid that.
Yeah. And just for the audience, I mean, short answer, but in terms of a metric of EBITDA coverage, do all sale leaseback operators that are publicly listed provide that metric? To my knowledge, not all of them do, or
Not everybody does. No, not
right,
everybody does.
right, okay. All right, let's just move on. I mean, we're running out of time here, but let's move out to outlook in terms of, I know you cannot give guidance, but how much can you grow your book this year, or is it or next, or is it more about being conservative, managing what you have? If you can touch on that.
Yeah, so at NewLake we get growth from three areas. The first area is we have annual escalators in our leases, very similar to you'll see across the real estate spectrum in every industry. Leases have escalators. Across our portfolio, it's 2.6%. So we collect rent and revenue goes up 2.6% for the year. Number two is our capital commitments. So we've committed over $11 million across a couple of projects. As that money is deployed, we start charging rent, and so revenue will go up once we deploy that capital. And then third is new transactions. We have over $86 million available on our credit line to execute new transactions. And so as we book new deals, we'll be utilizing that credit line and we'll be providing additional revenue. And so those are the three areas of growth. You asked a question related to growth earlier, and I don't know if I addressed it. You talked about kind of the slower pace, and I explained the reason for the slower pace, but I also want to come back and say, and we have a lot of sayings, but one of them is we don't want to grow for growth's sake. We want quality growth. And I've been saying that since we IPO'd in 2021. In fact, I was saying it in the private rounds. We want to have methodical, careful growth. And, it's an instructive story. I had an investor after our earnings call in March say to me, my gosh, how did you grow AFFO per share by over 8% in a year that was extremely difficult for the cannabis industry? And my response was, it's not what we did in 2024. It's what we did in 21, 20, 2022, in the deals that we did, and importantly, the deals that we didn't do. And so that was able to deliver that cash flow for us in 2024. And so when I think about growth, I think about making sure that we're not just doing deals, but we're doing deals where we can collect rent for the 15 or 20-year duration of the lease.
Got it. Thank you. Anthony, you've been very generous with your time here. I don't know if you're going to make any closing remarks here and perhaps pitch your stock again to the audience. But again, thank you for your time.
Yeah, well, listen, Pablo, thank you for the opportunity. I always love talking to you and talking about the industry and talking about NewLake. I'm not really going to make a pitch to folks. I think what I'd ask is I'd ask people that just look into the quality of our book, keep track of our company, look at that deep valuation, think about the long-term trends. And if you have any questions, reach out to us. We try to be as transparent as possible and as communicative as possible, doing podcasts like this with you so that investors can know more about how we do what we do. And also start to understand the careful approach that we take in underwriting transactions, assembling a portfolio of quality properties with long duration. And hopefully over time they'll appreciate it and the valuation of the stock will reflect the same.
That's great. Anthony, thank you very much. And everyone, thank you for joining today. Thanks, Anthony. Have a
Thanks,
good
Pablo. Great talking to you.